Get us started. I'll continue watching the waiting room and let people in.
All right, sounds good. Thanks, Whitney. So good afternoon, everyone. My name is Brad from Stessa. We are so happy to be joined this afternoon by our good friends over at Goodegg Investments, and representing their team is Whitney. So very happy to have her share her experience with us today. We're going to be sharing a whole bunch of different strategies and types of different real estate deals that investors should be keeping in mind these days as we're talking about entering tough economic times and as you explore different potential acquisition projects for the next couple months. So we're going to get into those today.
Awesome. Well, cool. I am the moderator here. Whoop, let's all right, Brad, there you go.
There we go. Okay, yeah, just very quickly about myself. My name is Brad Karche. I'm a multifamily developer in Ottawa, Canada, with 30 doors at the moment. I started in single family homes and condo investing, and then moved on to multifamily once I realized the power of scale. I'm also an executive at the Ottawa Real Estate Investment Organization, so very happy to be joining you all today. I also work with Stessa. And just so you know, Stessa is a free software that helps track, manage, and communicate the performance of your real estate assets. And it's free, and I encourage you all to head over to stessa.com to check it out.
Awesome. And my name is Whitney Elkins-Hutten. I'm a real estate investor. I started off with live-in flipping and house hacking back in 2002, total accidental landlord. And since then, I've scaled up to over 30 rehab deals, about $2 million in flips, and then I'm also a partner in over 3,000 residential units and 1,400 self-storage units. And in 2019, I joined the Goodegg Investments team, and I'm now the Director of Investor Relations there. And we focus on helping busy people invest passively in real estate syndications so you can create passive income without the hassles of being a landlord.
That's awesome. I love it. All right, let's get started.
All right.
Okay, so we're going to talk specifically about 6 types of real estate deals: new builds, single family homes and condos, rehabs, single family rentals, multifamily rentals, and different types of partnerships. And so why are we talking about these today? And the reason I'm really happy Whitney is joining us is because we all learn through experience. The best way to learn is to do, take action. And really what I think we're hoping investors take from this today is, pick a few strategies and explore them yourself. See if it'll work for your time frame, your local market. Little audio difficulty there. Anyway.
Have yourself muted, okay?
Yeah, so I mean, we just want to give people ideas today. That's what it's about, and that's why we're both on this webinar, to give you specific case studies of how we've fared in these different real estate strategies, both good and bad. So that's why we're doing this today.
Awesome. All right, let's get started. So the first strategy we wanted to go over is fix and flipping. And this is actually where an investor will buy a property below value, renovate the property, and then sell it at a profit. So it's a pretty straightforward, simple strategy. However, we wanted to talk about our strategies that we're going through today in terms of time, money, and expertise, so you can understand the different pros and cons from the areas that we're for each strategy. So with flipping, we have, the time, it's very time intensive strategy, and this can actually cut 2 ways. One, if you have a lot of time on your hands, it could be a great opportunity for you to create sweat equity and kind of, swing the hammer and create a business for yourself. But at the same time, if you don't have a whole lot of time to figure out how to find undervalued deals, work with contractors, do the renovations yourself, or even negotiate the deals, this may not be a good fit for you. When we talk about money, there's some interesting strategies with flipping. You can actually use what we call a hard money loan or a private money loan to secure the property. So that can actually help you create leverage and employ other people's income. But at the same time, even if you use hard money or private money or all cash, you're going to have a lot more money to get started into the deal because you have to actually fund the purchase and the initial construction budget, right? Now that also brings me to the next kind of con of fix and flips is the construction budget. That seems to be the biggest wild card in this particular strategy. So make sure that you're always adding in or holding different enough reserves to cover contingencies when in your budget. I don't know if anybody else has done flipping here. However, I can guarantee it's like death and taxes. Your budget's going to go over. You're going to go over budget in your construction.
Oh yeah.
Right. I've come in a budget once. Now, that said, all of these strategies, I want to just draw attention to that you before you get started in investing in any of these strategies, I would want for you to really understand that you need to have a minimum of 3 to 6 months of personal expenses set aside just to weather any storms. All right, so experience, right? This is one of the beauties of real estate is it is a simple business structure. However, if you don't have the experience to do flipping, you need to go partner with somebody who has it, okay? Because we'll go over some considerations here, and then you're going to want somebody on your team that understands how to flip properly. All right, so considerations. Number one, when you flip, you're actually creating an active business. So the money that you generate from flipping is going to be taxed at the highest tax bracket, your ordinary income. Okay. Now, we did touch on it a little bit earlier. You can create sweat equity with flipping. So that's a great way to get started. But however, understand that time is money, and that's not an easy way to scale if you're swinging your own hammer and doing your own painting. All right. And the key question here is with your real estate investment strategy, do you want to have passive income? Because if you do want to have passive income, then flipping may not be the right choice for you, okay? Because there's no long-term cash flow with this. But the cool thing with flipping is that you can recycle your own capital if done right, right? Now, how risky is it to flip? Well, flipping can be a little bit riskier than most of our other investment strategies purely because we just don't know how the market's going to react, right? It can move on you in a short amount of time. This is why I'll go over it in the best practices. This is why I like doing really flips with really short timelines. And also you can mitigate your risk by having multiple exit strategies. So that's hugely important as well. And we'll touch on several of these considerations multiple times throughout this presentation. All right, so here's a deal that I did. This was last year in Kansas City. I bought a 4-bedroom, 2-bedroom house, 4-bedroom, 2-bathroom, single-family house in a A-class area. It had 2,500 square feet in it. And I'm going to tell you, I'm pointing this out because this is probably one of the cool things about flipping. I purchased it with $235,000 on a hard money loan, and we budgeted that our construction was going to come in at $35K. Now, it actually did not. We ran into some construction issues. Again, you got to have that contingency in your budget. We actually found out that the entire back deck was termite rotted, the main post. So we actually unfortunately had to replace it. But the cool thing that we were able to do is we were able to create some immense value with this project. We were able to finish off the basement, and post-construction, we added another 900 square feet to the house, allowing us to push the value to $355,000 in a span of about 2 months. So that's amazing, okay? But again, no cash flow, but if you want equity pushes, this is a good strategy for you. Now let's talk about some best practices here. You know, flipping works really well if you can buy properties or source properties that are undervalued, okay? Also, I like working on flipping strategies that have really short timelines, okay? This way, the real estate market has less of a chance of moving on me before I sell. And as I've already pointed out 2 other times, I'll point it out again, make sure you have a contingency in your construction budget. I like adding in at least 5 to 10%. If the project is a larger project or if there's some key CapEx things that I am not addressing, I'll add more. All right. Now, make sure that you're working with a realtor because you want to take care of a couple of different things. One, that your after repair value on the property is solid. So you know what you're selling it for, and you're not going to go, spend too much money on the property between purchase and rehab. But also work with a realtor to fully understand how to rehab the property to the competition in the area. We don't want to over rehab or under rehab on the property. We want to be competitive with our market. All right. Also, multiple exit strategies is key. I see this is where a lot of flippers kind of get stuck, is that they bought a property where the only exit they have is actually flipping the property. And they end up, if the market moves on them, they ended up kind of riding the wave down. We want to have different ways that we can address the exit on the property and mitigate our risk. So maybe we can rent it out long-term, rent it out short-term, do a corporate rental, do a lease option. Make sure we have multiple exits on the property, again, to mitigate our risk. All right. And I'm just going to pause a quick second. I saw we are recording this. We will send out all the slides. So you guys don't have to rush to take notes or screenshots or anything like that. You will get all this material at the end. All right. And if you have questions, drop them in the chat box. We will try to pepper in answers when we can, and we'll also address questions at the end. I don't want you guys hanging on to them. Make sure to jump into that chat box. All right. Type number 2, turnkey rentals. All right. Now, I kind of bucketed this together. I mean turnkey, not necessarily we're working with a turnkey provider, but meaning when you close on the property, it's pretty much rent ready, move-in ready for us to start marketing and getting a tenant and start making cash flow. All right, so you can do this actually with a single family property, a condo, or a multifamily building. This is a strategy that kind of works across the board. All right, so when we're talking about our time, the cool thing with turnkey or rent ready, move-in ready properties is that we can actually create a ton of leverage here because we can actually work with a realtor, maybe even a property manager to help find these properties for us. Now, if you're somebody that has zero time to work on this, then maybe you want to work with a turnkey provider, okay? The turnkey provider can actually make sure that the property is tentative for you before you close. Right. Now, while we had a lot of pros on the time side with rent ready and turnkey properties, the cons kind of come in later on the money side. All right. Now, with the turnkey property, you can actually use conventional or commercial financing. So you have some great options there. Your construction should be pretty minimal, so you don't have to have a whole lot of skills and expertise there. If it's rent ready, you can get a tenant in there. You're going to be creating passive income pretty darn quickly. But now here are the cons. We can't recycle our funds nearly as quickly as we can with other strategies because, again, the money we're putting in for the down payment is the equity on the property. Okay, so we have to actually wait for market forces to work for us. All right, another con is it just takes more money to get started, right? If we're buying a $100,000 house, we have to have $20,000 minimum sitting on the sideline. And possibly you have to have additional reserves as well. Now, this is the exact reason why I don't like using lines of credit to get started in turnkey investing because it takes us so long to get our money out of the property. You essentially have 2 loans, you're paying 2 loans on the property. Okay, but I'll point out a couple areas where I do like using lines of credit. All right, another this isn't a con. We keep putting it in the con category, but this is just something everybody needs to do as an investor. Make sure you have those liquid reserves sitting on the sideline to help you weather your own personal financial situation as well with your property. All right, expertise. Well, you don't have to have a whole lot of expertise here because we can really leverage it out. We can use realtors, we can use property managers, we can use turnkey providers to help us figure out where to invest in the property and how to get it tenanted and managed and earning income really quickly. All right, let's get into some considerations here. Okay, this is the #1 area where I see people kind of trip up with the turnkey investment strategy. Is that they actually take the numbers that a turnkey provider puts out there at face value. Okay, so we want to make sure that you're really strong at running your own numbers. And guys, Stessa, right here can help you do that, okay? We want to make sure that the cash on cash is, is running what you are looking at, and I'll explain why we want to do that. The debt service coverage ratio is appropriate, and as well as that you're actually making an income on the property. We call it net operating income, all right? Always run your own numbers. All right. Real estate is an illiquid asset, right? Remember, we were talking about flipping, we're getting in and getting out. Okay, we're not holding on to this property for very long, but with a turnkey or a move-in ready property, you're holding on to it for 5, 10, 7, 10 years, maybe even longer. So we want to make sure that the market is solid. You're making money on the buy. So I like looking at the jobs in the area, the amenities, and the schools. There are other, this is not a holistic market analysis. We can deep dive in that later in the Q&A session. But again, we want to make sure that you are in a great purchase area and a buy area, because remember, we want to make sure that we have multiple exit strategies on our deal. We want to know how you're going to get out of that property in the end, even if you're going to hold on to it to 5 to 7 to 10 years. So for a turnkey property, perhaps you're going to sell, be in a market where you want to sell to a first-time home buyer or maybe another investor, or turn it into a long-term rental or a short-term rental, right? We want to have options. Again, help us mitigate our risk on the property. All right, here's the deal that I did in Indianapolis. It was a 3-bedroom, 3-bath house, single-family home in a B+ class area. Okay, great, located next to great jobs, great amenities, great schools. It was 1,400 square feet, a little over, and I purchased for $120,000. Zero construction budget, so that was awesome. But it did have a little bit of deferred maintenance. And guys, even if you're buying turnkey, you can negotiate the price on the project as well as key deferred maintenance items. And what I did here is that the fence needed to be replaced and the water heater, and I made sure that the seller put that into escrow, and whenever those things failed for me, I was able to have them replaced. All right, I used a conventional loan, put 20% down, and my whole time on the property was about 2 years. And I made a 40% annual return, just from the levered appreciation alone, okay? I also had the tenant pay down. I had, cash flow coming in from the property. I had the inflation hedge as well. So there's several other ways that we can get paid with real estate. All right, best practices. Let's cruise through these one more time. We're going to touch on these again. Repetition is the mother of all skill. So run your numbers. Always do your numbers. You want to make sure you're getting inspections and appraisals on any move-in ready property you buy. Even if the turnkey provider says they've already done it, I would still do it. Okay, that inspector and appraiser are working for you now. All right. Make sure that you're buying a home that actually cash flows. Okay, appreciation is really icing on the cake. Okay, Brad, I don't know how many times we've talked to investors where they bought a house and they only have $50 of cash flow or $100 of cash flow, and then the rental market moves on them, and wow, they're upside down. Yeah. Mm-hmm. That's so heartbreaking, especially right now in the market we're in. Make sure you have some play and you can remain competitive in the market with your rents. All right. Have exit options, okay? Make sure that you're preserving your capital. And Brad, I'm going to turn it over to you for condos.
Yeah, no, thanks for that, Whitney. And I couldn't agree more on the running your numbers and cash flow, especially when it comes to single family homes and condos, because when you compare it to other asset classes like multifamily, where you have 20 units, the cash flow tends to be a lot tighter on the single family homes and condos. So you can be underwater pretty quick. And as you know, you make money in real estate when you buy. So if you're tight from the beginning, then any sort of market downturn or global pandemic, and you could be underwater with your assets. So that's very important. Okay, yeah, moving on to condos. So this is where I got my start investing, and it's a really good way to build up a portfolio in just a couple of years. I always bought new construction condos because you're essentially getting a real estate asset at today's price, but in a year or two down the road. So what this typically means is that you have a nice equity boost once you take possession because of market appreciation. Condo purchases are very market specific, so be sure to be intimately knowledgeable about the markets you invest in. Condos are also very easy to manage and rent out, as they typically are well located, have a nice amenities, and a manager who takes care of all the maintenance outside of your unit. So some pros and cons, as with anything in time, is a big one. So one of the pros is very little of your time is needed. You know, for fix and flips, you're in there swinging a hammer. It takes time, takes a lot of energy. With condos, it's very simple and straightforward, especially with new builds. They also have condo boards, you know, also called homeowner associations. You know, they issue all the rules and guidelines and conduct all the management. So there's very little for you to input on. But that's also a con. You have very little to input on. So, you know, you don't have any freedom to do, you know, whatever you want with the condo. You pretty much just, you know, buy, rent long-term, renovate if needed. And things like short-term rentals are sometimes not allowed. So you have to be cognizant of that. Moving on to money. One of the pros is, you know, you require a standard loan to value for condo investing, but if it's a new construction, then usually deposits can be spread out over a 12-month period. So I'll get into an example that'll explain this later. A downside is that you pay condo fees, which typically always go up year over year. They never go down. So this is a sunk cost that is really, you know, beyond your control. Moving on to experience, the best thing about condos is you don't need a whole lot of experience when you're buying investment condos. Again, if you compare it to the BRRRR strategy or fix and flips, where, you know, like, I should never be the one swinging a hammer. I will hurt someone or myself pretty darn quickly. So that's why I gravitated to condo investing, because I was a lot more comfortable operating in that space. Okay, moving on to some considerations. One of the big ones is be very careful if you're getting into short-term rentals with condos, because you're at the mercy of the condo board, who may end up banning them, and then you're stuck with long-term renters. I prefer long-term renters for condos to avoid this, or at least make sure, again, going back to the numbers, like Whitney said, make sure your numbers still work with a long-term rental scenario, even if you're getting into short-term rentals. Another consideration is up and coming versus established neighborhoods. So this is going to have a strong dictation on price, as it does with single family homes. So you may pay top dollar for a high-end neighborhood. I suggest looking at outlier and gentrifying neighborhoods because you're likely to get a lot better appreciation. Another consideration is buying in the different phases of development. It's less risky to buy at the end of a development cycle, but you may be, you know, the units are probably more expensive and there's less supply to choose from. Okay, so a quick case study. There's one of my beautiful studio condos in Montreal. I've purchased 5 of these over the years, and it's really very straightforward. So you try and be one of the first ones to own a condo, to own in the condo development, because this is when prices are likely the lowest and unit availability is the highest. So I bought my first condo in Montreal in phase 1 of a 4-phase condo project. It was a studio that I paid $120,000 for, and this was really a gentrifying neighborhood, which I suggest all of you look at similar types of neighborhoods in your cities to see where the up and coming neighborhoods are. I also only had to provide 5% down 4 times over 12 months. So it wasn't one shot, 20% down. I could spread it out over the 12-month period and had a bit of flexibility with that. And I really only had to go in to pick my finishes. So it was very, very hands-off. And then when it came time to take possession, I already had a renter. And 5 years later, I sold that condo for $210,000. And that was primarily because of, again, market appreciation, and I chose, you know, the gentrifying up and coming neighborhoods. So moving on to some best practices. One thing that I always suggest, this isn't true all the time, but most of the time it is, always buy the smallest of any one unit type. So for instance, if you want a 1-bedroom, get the smallest per square foot, as they will likely be the cheapest, but your rent will still attract a full 1-bedroom rent. And again, if there's any questions about this, please type them in the chat room. You can always ask for incentives. You know, like Whitney said earlier, you can always negotiate. So always ask for incentives. Are there any bonuses being offered by the developer, or is the seller willing to include anything in the sale? Also check your state and federal laws, and ask your accountant, obviously, but about any tax incentives for purchasing a new construction property. In Canada, we have tax rebates, which, for example, my 20% down actually turned into only being about 8% down after I received some rebates. So make sure you check with your accountant on that. And the last thing I'll mention here is landlord insurance. I have a lot of investor friends who think, well, because the building has insurance and the tenants have insurance, that you don't need insurance. And that's a big no-no. Landlord insurance for condos is an absolute must. It's very cheap, but you do need it, and it's a very specific policy type. So make sure you get landlord insurance. And I'll pass it back over to Whitney.
Awesome. Yeah, I've always been curious, like how you get in on condos, and that's such a neat trick that you just got to buy early. Oh my God. I'm learning stuff here. That's amazing. All right. So let's move on to type number 3, rehab rentals. This is the strategy that's near and dear to my heart. You might know it as the BRRRR strategy, but let's kind of recap what that is. So you're buying a property below value. You're completing a rehab or a variety of renovations, okay? Sounds like a flip, right? But this is where we're transitioning, okay? Then we are gonna rent it out and then refinance to get all of our capital out or majority of it out. And then we're gonna repeat. It's an amazing strategy. All right, so pros and cons, time. This can be a really time-intensive strategy to learn, not gonna lie, because you have to get really good at sourcing deals, negotiating deals, working with contractors, working with property management, right? You're kind of moving backwards on that time scale, but you get a greater reward for doing that. However, there are some people out there that are what we call BRRRR key providers now. So that's kind of an interesting little field that's popping up. So they're like a turnkey provider, or actually they probably were a turnkey provider, but now instead of them taking on the sales risk, they're passing that risk on to you. So they're finding the deal for you, they're managing the construction, they're gonna put a tenant in there, they're gonna place it with property management, and you're gonna be paying for those costs along the way. They have several key points of where they're making money. Another kind of sneaky way that I like getting a BRRRR done is leveraging the property manager, okay? We can leverage a property manager to purchase property, do light rehabs and construction. They're really connected. They have all the systems there. And maybe your property manager doesn't even know that they can actually provide this service for you, but it can be another cost center for them. So if you're interested, talk to your property manager about what they can do for you. All right, money. All right, money, money, money. Everybody wants to know about the money. With BRRRRs, we can actually leverage a lot of other people's money. I see a lot of investors that feel they have to get in and use all cash in this strategy, which is completely not true. We can use private money lending, we can use hard money lending in order to get started. Now, remember, I said I don't like lines of credit for turnkeys and make rent-ready properties. I do like lines of credit for the rehab portion of a BRRRR, because we're gonna deploy it, refinance, get it out. Deploy it, refinance, get it out. So we can actually leverage that pretty well. Again, that kind of alludes to that we can use the same capital over and over. And the key difference between this strategy and flipping is that we actually get to flip and have it harvest the equity and create the passive income for ourselves, okay? So that's awesome. Now, you do need to have some money to get started. So you have to be able to fund the upfront purchase of this, the rehab, and the reserves on the particular property. And we need to have contingencies. Again, remember, we're dealing with a construction budget. We have to have that contingency. And the crux of a BRRRR project or a rehab project is the second refi, okay? The second appraisal on the refinance, okay? So we're gonna get into some best practices on how to mitigate this, but we need to have some contingency funds in place for that second appraisal, okay, or on the refinance. Now, experience, you do need a lot of experience, or somebody on your team needs a lot of experience to execute this, okay? This is really hard for somebody who's really new to go out alone if they don't have some sort of support and mentorship or an amazing team in place, okay? You can start small. That's the beauty of this. Single family homes, studio condos, and you can apply all these learnings and scale up. we really took this concept of value add strategy and turned it into the BRRRR strategy. We actually took this from the multifamily world. That's what a lot of syndicators do. That's what we do at Goodegg, is that we buy properties below value, we rehab them, we push the equity on them, and then we hold on to for cash flow. That's the exact same strategy here, and you can do it on a single family house pretty easily, okay? And the key value here, connecting it back to fix and flipping, is it's all about what kind of value can you create that other people don't see. So let's jump into some considerations and then work our way through the best practices. Are you set up for success, right? You make money on the buy in this strategy, okay? I see a lot of investors that will buy the property, they're really excited to get into construction, then they kind of go, oh, okay, how am I gonna work on the refi? Or, you know, what is the true ARV on my property? We need to have all those puzzle pieces actually figured out when we purchase, because knowing what the market is, the submarket, the neighborhood, is that area a desirable rental area? Those all play into our business plan. So we want to kind of have that all laid out at the very beginning. And like a flip, we want to make sure that we're rehabbing to the competition. Now we have two competitions that we need to consider here. We have the sales competition. So are we over rehabbing or under rehabbing to be able to resell it if we need to? And what are the other people doing, other landlords doing to rent their property? We want to make sure that we're actually competing well with them in the market. Okay, so this is where a realtor or a property manager can be very key in helping you figure those things out. All right, here is my little BRRRR that I did in Kansas City. Again, I did this last year. It was a 2-bedroom, 1-bath, single-family house, about 1,200 square feet. Now, for you seasoned investors here, 1,200 square feet, 2-bedroom, 1-bath. What do you think I did? I went and put in a 3rd bedroom. There has got to be a 3rd bedroom in there somewhere. Also, the realtor failed to market that there was a full basement below this property, okay? I didn't finish the basement. I left some value add for other people to do. But that was also a key marketing strategy as well. I purchased this home for about $72,000, and then it only took me about $8,000 in order to just update the paint, replace countertops, and then I literally just had to add 1 wall for the bedroom, okay? And that took about 2 weeks to finish. Now, the cool thing about this strategy, while I intended to hold on to it, I actually had another investor come along just a couple weeks later. Now that I got this property all up to speed and rent ready, got it tenanted, and he offered me $125,000 cash. Remember, I only had 80 grand in. He offered me $125,000 cash. Guess what I did? I took the money and I went and did 2 more projects just the same. So
hard to say no to that.
Hard to say no. So, but let's talk about the best practices here, okay? Again, run your numbers, okay? Make sure that you're doing the numbers again at the beginning, okay? We want to address any of these cash flow issues, debt service covered issues at the beginning. Another point here is make sure to line up your refinance lender at the beginning of a project, okay? Because they're going to be able to guide you on where they feel the ARV will come in, what the debt service coverage ratio will come in at. So you can actually take care of that all at the beginning. Again, know that after repair value, your second refinance, or excuse me, the second appraisal or the appraisal of the refinance is going to be very key to actually executing this strategy well. All right. And then you can recycle the capital. Okay. So you can actually, if you have 50 grand to get started, you can continue to scale up over time by recycling that capital. All right. And then think of ways that you can add value. Can you add a bedroom? Can you make the basement storage? What can you do here? Again, creating value. I'm going to take a pause. I saw a question that came in here before we move on. Is that okay, Brad?
Yeah, go for it.
Awesome. Okay, so somebody wanted me to go through the numericals on this. Great. So on this particular property, we have $125,000 after repair value. So to execute a BRRRR, ideally, you want to be all in for 70% of the after repair value. So let me grab a quick calculator here. So that means my target, I needed to be all in on this project for 93,750 in order for my refinance to go swimmingly well and not leave any of my own money in the deal. So then you back out what your construction is going to be. So if I only needed to be at 93,000, then I back out the 8,000, and then that becomes the highest purchase price that I should pay for the property. Okay, so that's just kind of a quick way to analyze the BRRRR. Okay, all right. So, and I'll tackle some rest of the questions later on, but I want to make sure we get through all the different strategies we're talking about today.
Yeah.
All right.
No, thank you. And I think recycling the capital is such a good point, and that sort of segues nicely into the new builds, which is my sweet spot as an investor for several reasons that I'll get into. So basically, new builds are exactly what they sound like. You know, you find vacant land or underutilized land, you demolish old structures if needed, and build a new building on it. Easy, right? So this is typically called infill development. So why new builds? I live in an extremely hot real estate market. Ottawa may be a very cold place to live in the winter, but our real estate sector has been scorching over the last few years. So what this means is that resale properties are expensive, and you have bidding war scenarios on almost all of them, and they sell within 24 hours. So it makes it very hard to compete. And as I've said before, as investors, we know that we make our money upfront when we buy. So overpaying is just not something I'm interested in. So a while back, we decided to do some new builds, and that way we control the location and price. So some quick pros and cons. And in terms of time, a con is that this takes a lot longer, obviously, than a typical resale transaction, because you have to acquire the land, you have to demolish, build, finance, refinance. So the whole life cycle of new build is a lot longer. That said, on the pro side, if you have a strong deal pipeline, then this longer time frame can be less of an issue. Moving on to money, con is you still require the typical 75 to 85% LTV for new builds. But on the pro side, you're able to control your income and costs a lot more. And we'll get into that in a minute. You may end up needing less money down depending on the outcome of the build and your net operating income. For experience, you need a lot more experience for new builds than you would for other types of deals like condo investing that I spoke about earlier, just because there are so many moving parts with a new construction. So you have to make sure your team is experienced for this. So some quick considerations, you know, just on that point, you have to have an experienced builder on your team, or you yourself have to have experience in the management of construction, because it's a much different, you know, expertise that you need for new build. Another thing is you have to become a zoning expert. You know, this means taking your local counselor and city planning official out for coffees or emailing them regularly. You need to know exactly what you can and can't do on the land before you lock it up. I know it's dry, but read over your local bylaws. And if you're doing your first new build, then partner with a consultant who has experience in city planning and zoning bylaws. For new builds, you're going to need construction loans, which are much different than traditional ones. So you have to work with an experienced broker on these types of real estate deals. A quick case study. We just went firm on 2 parcels of land side by side in Ottawa. One has a duplex on it, and the other is vacant land. They're zoned both to accommodate non-conforming fourplexes. The duplex on the one lot was occupied with tenants that were paying well below market rents, which, you know, that meant that the income wouldn't cover our carrying costs. So we actually negotiated with the seller to provide vacant possession so that we can rent them out later when we take possession at market rents. So a lesson there is don't walk away from a deal just because the rents are too low. You may have some ability to negotiate with the seller. So now we're actually rezoning the lots so that we can build a 6-plex on them. And we have estimates for our 6-plex build in the range of building costs for about 170, again, Canadian dollars per square foot. And then we have an NOI estimate of about $100,000. So using a conservative cap rate on that, we're looking at a future value of about 1.7 million. Because our cost to build is controlled, we're looking at a nice refinance scenario. once the new build is complete and stabilized. And for those of you who don't know, stabilization period is just that time period, usually 6 to 12 months, where you get tenants in and expenses all on the books, so you know exactly what your net operating income is. So this is our new build strategy. We buy, build, refinance, and hold. And again, happy to answer any questions in the chat about this. So quickly, best practices, some things I've learned the hard way along the way. But again, that's how we learn, and that's why we're having this webinar. So make sure you know all the costs to build up front and have solid estimates. We've had a situation in the past where we missed actually a local building code requirement for separation walls, which once we found that out, it added about $80,000 to our build costs. So not great, but this is why you absolutely have to have someone on your team who has done this before. Another best practice is keep track of everything. So as investors, we should all be about processes and automation. And with new builds, there's a lot of efficiencies to be gained if you keep documenting everything you do as you move along through the process. And one final best practice that I've learned is find carryable assets. So what I mean by this is find your version of the duplex I noted above. If you can find parcels of land that you're going to develop on that have an existing structure on it that you could rent out while you're doing the development, that's going to dramatically improve your IRR and really help with your cash flows and reduce your risks. Okay, I'm going to jump quickly. I know we'll stretch for time, but I'm going to run through multifamily rentals quickly, which is sort of similar to the new build, but this is talking about resale, not necessarily new builds. So in terms of multifamily, I am really interested in the missing middle, and missing middle refers to this general lack of supply of 2 to 6 unit multifamily. You know, back when cities were more walkable, when transit wasn't as widespread, you'd find a lot of single family homes that had multiple units in it. These were typically 2, 3, 4 plex assets. This is what the missing middle is, and we are in dire need of more of it. And this is also my sweet spot when it comes to multifamily rentals, but I layer on the need of missing middle to the new build strategy that I spoke about earlier. So some pros and cons. Oh yeah, quick fun fact about the financing. I think someone asked a question about this, but when you go above 5 units, you're into commercial lending, which is much different than residential lending. The big difference is residential lending is all about comparables. What did a similar asset down the road sell for last week? That's essentially what your price is going to be. With 5 or more units, it's commercial financing, which is based entirely on the income approach, which is based on your net operating income and the cap rate of the local market. So you have a lot more flexibility to control the actual value of your asset. Okay, quick lesson. Moving on. Time for multifamily. If you're not building new, missing middle requires a similar amount of time to acquire as a single family home or condo would. Because basically these are assets with the same general footprint as a single family home. They may be a bit bigger, but they just have more livable units in them. In terms of money, they typically cost a bit more than because there are more units, but they do generate more income. So that's definitely a pro. And so you can therefore make more money because you're generating more rental income per square foot. In terms of experience, the great thing about missing middle is that you don't need a massive amount of experience to acquire these assets. Again, very similar to single family homes, but just bigger and a couple extra units in there. So just quickly, a couple considerations. Missing middle is extremely flexible. You can convert almost anything from a townhouse to a single family home into, at the very least, a duplex. You're limited only by your imagination. Know the market. It's really important that you know rental comps in the area, so you can know exactly what that cash flow is going to be. And you will also have longer timelines because your buyer pool of multifamily is less than if you have a single family home or a condo. You just have to be prepared to hold that asset for a longer period. And a really quick case study I'm going to get into is a duplex plus ADUs, so accessory dwelling units. So we had an empty lot in Ottawa that was zoned for R2, which meant 2 units only. But we were able to build the duplex with large basement accessory dwelling units, in-law suites as well, granny suites, but essentially non-conforming units in the basements. So that essentially turned this project into a de facto fourplex. So we easily found tenants, particularly because this was a new build. And the best thing about Missing Middle is that you can find these gems anywhere. And the lot we built on was severed from a larger residential lot that had a massive backyard. And it was simply a matter of looking at this one lot and saying, you know what, they have a lot of extra space on this backyard. It's on a main street. Let's sever the lot and build something here. So quickly, some best practices. Because you may be converting or adding ADUs, make sure you're intimately familiar with your local zoning laws and building codes. And again, I mentioned before insurance, but I don't need to go over that again.
Get insurance.
Okay, quickly, we're going to go into partnerships. I don't want to go into too much detail about JVs because you really need good legal advice on this. That's all I can say. Get a lawyer who has experience in JVs. But really, there's two general reasons to get involved with JVs. One is to bring on liquidity after a deal is done. As we know, real estate is illiquid, and we may want some liquidity, but don't want to sell. So the option then is a HELOC or refinance, but another option is bringing on a JV partner. Number two is to bring liquidity before a deal closes. So on my sixplex example that I talked about above, we brought on $200,000 of JV money for 20% ownership in the deal, and that gave us all that initial capital upfront to have a sort of funds for the construction float as we were building. So some pros and cons. So you're giving up equity in your project for capital, but there's a whole bunch of ways to structure this, and this is really a pro. You can, you can structure a JV agreement in 100 different ways. You can have a private JV loan. You can have equity and cash flow JV. You can have a preferred return, and the list goes on. So really, the best practices here are lawyer, lawyer, lawyer. And another one that I've learned the hard way is make sure your JV partners are aware of your long-term and short-term strategy for their money. Make sure they know how long their money is going to be tied up for, because they may have different goals than you for their funds. And I'll toss it over to Whitney for syndication.
All right, guys. I got a little fat fingered on the buttons here, so I'll just pop up these considerations and best practices real fast so you guys can take a look at it.
Sorry, I think I whipped through that quickly.
You did. I was having trouble keeping up with you, and then I went the wrong direction.
I was looking at the time.
All right. So, so Brad just recapped joint ventures, and we're going to talk about a little bit about syndications. And so syndications, let's just think of it as a joint venture scaled up. All right. So a syndication, for those of you who don't know what the definition is, it means a group, quite simply. So, in most syndication deals, there's actually two groups. There's the general partnership group and the limited partnership group. So I'm going to go really quickly through both groups here. So right now we're talking about the limited partnership. Okay, the limited partnership are generally the part of the group that is bringing the down payment and the capital expenditures to a deal. As a limited partner, this means you can create truly passive income because you are leveraging operators' time, knowledge, expertise, credit, other investors' money. It's a beautiful place to be. However, you do need to take the time to learn how to vet a sponsor, vet a market, and vet a deal. And this is very different than single-family investing, where a lot of people vet the deal in the market that's in their backyard and then turn around and place it with a property manager. We're actually doing it reverse because you're investing in a business. Okay, it's an active business. But the cool thing is you get to leverage tons of money. Okay, now it does require about 25 to 50K to get started. And this is kind of cool because you can actually put large chunks of money to work. But this is not for somebody who only has $50,000 in the bank. Okay. But once you vet and fund your deal, the income is truly passive. Now, with all of our investment strategies, make sure you got a solid financial foundation and you've got your own reserves taken care of. And you may not be able to recycle funds nearly as quickly as you can with other strategies. However, there is a syndication out there called value add. Okay, not a development. We're not doing ground up construction, but value add, where essentially we're taking a multifamily building, we're buying it below value, pushing it to market rents through 3 different strategies, and then refinancing out our capital at about 2 to 3 years. And then we'll recycle it and do the next deal again. So it can be an extremely powerful strategy. But experience-wise, as a limited partner, you just need to be able to make that initial investment, choose the right operator, market in the deal in that order, and then you get to leverage the operator for the day-to-day operations, okay? It's not you, it's them. Now, for some considerations for the limited partnership, are you comfortable having your capital invested for 5 to 10 years, okay? It takes about 2 to 3 years to rehab the project and maybe another 1 to 2 to 3 years to sell the project. So it can actually, your capital can be invested for quite a long time. And there's also the difference between being an accredited and sophisticated investor. When we get to projects of this scale, we're bringing in the Security and Exchange Commission. And so we operate under the Regulation D, 506 ruling for accredited only investors, and then 506B ruling for sophisticated investors. This is why a lot of sophisticated investors I talk to, they're like, I don't know where the operators are. Well, because if they're operating under a 506B ruling, they can't solicit investors. So it's really tricky. So this is my #1 piece of advice for you. Syndications is something that you want to do. Network, 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 network to find those operators. Now, on the general partnership, okay, these are the people that are actively running the business, okay, on behalf of the limited partners. It's super time intensive, but yay, it's super time intensive, and you get rewarded with the money on the back end of the deal because you get to employ other investors' money. You'll probably want to invest alongside your investor to create alignment. But you actually are taking on the highest reward, the highest risk, and also get the highest rewards. Okay, and then experience. You need to have a ton of experience because not only are you managing a large asset, you're managing other people's money. Okay, so you definitely want to make sure that you have the experience. Somebody on your team has a lot of experience as well. All right, so. Considerations for a general partnership, simply, do you know what you're doing? Okay, if not, you need to invest a large amount of time in your knowledge and expertise to acquire the asset and acquire the investor and get a solid background behind you. Okay, and again, do you know what you're doing? We're so important, we repeated it twice.
Yes.
All right.
I think we repeated a few things here, so that should be a signal to the listeners.
Yeah, totally. Wait, Brad, I'll let you take over the main takeaways here.
Okay, yeah, no, I think what we're going to do is all of this is recorded. These are the key takeaways. So I'm not going to read them out because this video and the slides will be sent out once we're finished. So you'll be able to review all of these during your own time. So I think we should move on to questions. What do you think, Whitney?
Yeah, sounds great. So guys, jump on over into the chat box.
I have 2 here that I could answer quickly if you don't mind. Okay, so I had earlier on when I was talking about condos, I had Ellie ask about to elaborate on buying the smallest unit of any one type. So this isn't true all the time, but usually, so for example, a 1-bedroom will typically range between 450 to 600 square feet. I mean, that's a general rule. There's smaller and there's bigger. The price difference between the 400 square foot 1-bedroom and the 600 square foot bedroom will be quite substantial. So, for example, we're talking about maybe $100,000 difference. I've seen those price swings, but the rent that you can get for each, yes, you'll be able to get a little bit more rent for the 600 square foot one, but run your pro formas, and I will bet you that the smaller 1-bedroom unit, because it's a cheaper price, will get you higher cash flow. So just keep that in mind as you're looking at condos, that there's different opportunities to improve your cash flow and maybe spend a little bit less money. And the last one I saw for me was from Sorab about what was the size of the build for 900,000. So asking how big the apartments were. So actually with that particular sixplex, each was a 2-bedroom unit. And they were 900 square feet. So keep in mind as well that $170 a square foot was is total. If it's below grade, it's actually going to be cheaper for you because you already have the bones in place than above grade. So anyway, yes, there were 900 square foot 2-bedroom apartments, and our rough construction costs for that were $900,000 for the whole building.
Awesome. Oh my gosh, Brad, I'm so excited about the Miss Middle that you did. We are working on actually a similar project here in Colorado. So that was so refreshing. And thank you for pointing that out. There's a couple of questions in here regarding the rehab. All right, so that rehab was located in Kansas City, Missouri. And yeah, I actually, again, I bought it for $72,000. I put $8,000 in, so I was only into it for $80,000. And remember, we calculated 75% loan to value on $125,000 is 93 and change. So I could have, if I did refinance it out, I could have rolled in my closing cost into the deal and had zero into it. So you can do that. You can, when you do a refinance, you can do a rate and term refinance or a cash out refinance. And yes, you can roll in closing costs if there's enough space in there. And as far as the timeline to refinance out, I've written a lot about this on various forums. If you buy all cash, yeah, you do need to let the title season if you're going to refinance out conventionally. And for most lenders, that is 6 months. If you're going to refinance out commercially, then you could probably get it refinanced out in about 90 days. After that, if you use a hard money or private money loan, as long as they put a note on the property, it's actually a recorded note, you should be able to do a rate and term refinance immediately. So that's really why I love using hard money and private money on my projects, not only because I can create velocity with my own money and have less of my own money in the project, but because I can actually get to the refinance a lot quicker. Yeah, that's kind of how I make that happen.
No, I love that, Whitney. And the secret sauce to the new build construction is the refinance scenario after a stabilization period. It's so powerful, and once you do it once, it gets a lot easier.
Ooh, we just had a great question come in. I take out loans to buy my rentals. At what point am I over leveraging? Brad, I would love to hear your feedback on that, and then I can chime in.
Yeah, I mean, again, that there's so many other factors that would weigh into providing a good response to that. I would just say be very careful. It would depend on the type of loans. If you're talking about maybe if it's a HELOC that at least in Canada, they're tax deductible and you're doing that maybe once, I would say it's fine. But if you're taking out other loans and over leveraging beyond, the 80% LTV on your rentals with private money and that kind of stuff, I would, especially in this environment, I would just say, please be very careful.
Yeah. So I echo Brad's sentiment here. I'll just I'll like embellish it on the rehab side. On the rehab, the reason why I like using rehab or the BRRRR method is because I'm actually the 25% equity or whatever that number actually ends up being according to my business plan, that'll actually carry me. That's the down payment. That carries the down payment on my new loan. Then I'm only 25% equity into the project. It's the property's equity, not my equity. Now, do I want to lose that if I need to fire sale the property? Absolutely not. I mean, because that's one of my wealth generators. But I am hedging my bets against a down market. And also, if we're talking about conventional loans and you're putting 20% down on conventional loans, personally, I wouldn't go any lower than what you're comfortable with there, because then you're really having to depend on market forces to raise the value of your property so you can sell. So even if you put 28% down, that's not even that well protected if you have to use a realtor to sell their property. Yeah, I would just take great care. I mean, lending is amazing. We can create leverage returns, leverage appreciation, but it can also cut the other way at the same time. So you got to be
yeah. And if you hit a downturn and that equity gets squeezed, you could be underwater pretty quickly. And so the stronger your equity position, the better you're off. But obviously, there's a balance as investors. We want to redeploy capital, elsewhere and quicker. So it depends on a lot of different things. And at least for me, I have an accountant who's a specialist in real estate, really helped me out with figuring out Not only that, but reserve funds and how much it's good to have in a reserve fund for different types of projects, as well as my entire portfolio. So again, it's, real estate's a team sport. So make sure you're talking to people who are experts in these type of financial matters.
Mm-hmm. Yep. Ooh, I'm going to throw in one other hot tip here. Try to keep your debt service coverage ratio on a property above 1.25, and you'll never get shut down from, I shouldn't say never. I can't ever.
Never say never, but that's a good, that's a good.
Yeah, the chances of you getting shut down from lending are especially if you're going into investor lending or commercial lending, the chances are very slim. So keep your debt service coverage ratio at 1.25 or higher.
And if you don't know how to calculate that after this, go on Google and figure it out. It's pretty straightforward, but it's something you need to know to be able to do back of the napkin analysis on your properties.
Awesome. Well, hey guys, we have time for a couple more questions. Throw them in the chat box. I really appreciate everybody being on with us today. I know we've gone a couple minutes over, but I hope you guys found immense value. And we tried to squeeze a lot of content in a short amount of time. So, jump in the chat box. We'll hang out for a couple more minutes. Buying a home with a tenant in place, 4 months left on the lease. Can I have the seller put 4 months rent into escrow to protect myself in case the tenant does not pay rent? Yes, you can.
Yeah,
you can always ask for it. Why not?
Brad? Yeah, we don't use escrow a lot in Canada as much as you do in the US, but yeah, as from my understanding from doing a lot of investing in the US and having a lot of friends there, you can negotiate anything you want, not anything you want, but you can get very creative. If that's a serious concern for you, you could ask the seller for that, or you can ask the seller to provide vacant possession as well. And a lot of people do cash for keys or other ways to get the renters out there. I don't like inheriting tenants, so I would be very cautious about taking on someone's tenants.
Yeah. Also, you want to make sure that you're in part of your due diligence process, you're reviewing the lease. If you can get a trailing 12, for expenses, income and expenses, that would be fantastic as well. A lot of mom and pop landlords don't even know how to do that or put it together. But that will kind of give you your first clue as to what's happening. I would also get an estoppel agreement signed as well, but from the landlord and from the tenant, so everybody's agreeing that this is the lease and this is what should be paid.
I have
two other.
Oh.
I was going to say one more question. Brad, you ready? One more question?
Sure. This one's about finding a real estate focused CPA. Asking where mine is based. Mine is based in Canada, but there's CPAs everywhere. So I would suggest, talking to your network, Google searches. I guarantee you there's a CPA who is focused on real estate, within, 20 miles of your house. So do some research and find a CPA who is absolutely focused on real estate investors.
Awesome. Hey guys, thank you so much for joining us today. It's been amazing. We have recorded this and we will post the recording as well as the content and send it out. And we really appreciate you. Look for an email from us later on today with that information.
Yes, thank you everyone so much. Thank you, Whitney, for sharing all your insights. Please, everyone, go check out Goodegg Investments. They have amazing content on their website. So I leave you with that, and happy investing, everyone.
Absolutely. Thank you so much, Brad. It's been such a pleasure.
Yeah.
All right.
All right. Bye, everyone.